All right, market heroes, we're back. I have a really fun one for you guys today. This is a strategy, this heavy dynamic straddle. This is a strategy I actually haven't used my entire trading career. Only about the last year have I started to use it, and it's been a really successful strategy for me. And it's a trade that gives you the potential for enormous return on capital. I'm talking well over 102% return on capital potential. So it's really an amazing strategy. And a lot of people kind of, when we think straddle, the first thing that comes to mind is we think of the most profitable strategy that we have in the Market Hero course, right? In terms of options traders and options sellers, yes, that is correct. Selling a straddle is the most profitable strategy over the long run, right? If we're selling straddles at the right time, we could make an average of $7 per day on a one lot. However, obviously, with the higher upside potential comes the potential for the largest risk too. During the financial crisis, a one contract straddle resulted in over a $3,000 loss. So a lot of you are saying, well, $3,000 isn't that big of a deal. Per one contract, that's pretty big. And the reason that's pretty big is that is a $30 loss in the S&P 500 on top of the credit that we already received. Now, when this trade was going on, this was about at the time when the SPY, which we did this study in, was trading for about $100 a share. To have a $30 loss in SPY in a at the money straddle was about a 30% loss in a 45 or 50 day period, in a 50-day period in SPY. That's pretty bad, right? Now, over the long run, it's our most profitable strategy by far. We collect the most amount of money. If we collect the most amount of money, thus we have really wide break evens, and our management strategy with straddles allows it to be a really profitable strategy. So a lot of people are saying, look, Steven, I can't handle $3,000 loss. I know that straddles are the most profitable strategy, but could we do something better, right? And they typically look at our dynamic straddle, right? So our dynamic straddle is obviously selling a straddle, but buying wings at different deltas to define our risk. Our max upside is lower, but our max potential loss is lower too. It's no longer defined. It's a defined risk trade, and it could be done in something like an IRA, a 401k, or a cash secured account. So a straddle obviously involves selling an at-the-money call and put at the same time, right? So for those that need a refresher, right now, SPY is trading for 249.21. The 249 strike is the closest to at the money, so that would be like selling the 249 call and put, right? So we collect $5.28 for that. So our break evens are all the way down to 243.72 up to 254.28, right? Our max profit is $528 and our max loss is undefined, right? So this strategy can only be done in a margin account, right? And obviously we make money if prices fall between our break evens for the credit we received, or if volatility decreases over time, right? So when we're selling an option, we want to buy it back for cheaper, right? We want to buy those options back for cheaper, right? So if implied volatility decreases, if you remember, options are priced off of implied volatility, the price of those options will go down as well, right? So that's a normal straddle, right? But to make it a heavy dynamic straddle, we're looking to sell multiple call spreads, which will increase the amount of credit we received and not increase our capital requirements or our potential losses, right? So I'll get into that in a second about exactly what that's going to look like and how we can do it today in about a second here, right? But to see how profitable the strategy was for us, to see if it was more profitable, again, doing this, if we're selling multiple call spreads without increasing our capital requirements or max loss, we're getting a higher credit for doing so, right? So will the higher credit for executing this strategy result in a higher P&L over time, right? So let's take a look. What we did was we did a study from 2003 to present. So that's 14 and a half plus years, depending on what time you're watching this study. right? So SPY, every single day we sold the at-the-money straddle and purchased the 30 delta call and put on each side to create a dynamic straddle, right? And again, this is a defined risk trade because we're buying the calls to define our risk, right? So what we're trying to do is sell as many call spreads as we could within this dynamic straddle, which would not increase our capital requirements and create now, right? Because if we sell more than one call spread for every single put spread, it becomes a dynamic heavy straddle, right? And we do this as always in the monthly expiration cycle closes to 50 days from expiring, and we buy back this heavy dynamic straddle for 25% of the credit we're receiving, right? So what does this look like? So when I did, this is funny, when I did these notes yesterday, this is what the numbers looked like. When I do them today, they'll be a little bit different. The market rallied over 1%. Implied volatility came in a lot. And now the market, the SPY, is trading at all-time highs. So it's not going to be the exact same numbers as you see here, but let me go through. All right, so the example is selling the 50-30 delta dynamic straddle, right? So that's a 247, 250 call spread and a 247, 241 put spread, right? We collect $313. We have no upside risk because remember that call spread is only $3 wide. So we have no upside risk, and our risk to the downside is 313 subtracted from the 247, so 243.87. Our max loss and our margin requirement to execute this strategy is $287, which means our max return on capital at this time, our max return on capital could be 109%. Pretty good, right? Now, on the right side, we're going to see what happens with a heavy dynamic straddle. So again, it's the 50-30 delta, it's the 50 delta put and call that we're selling to create the straddle. We're buying the 30 delta call and put, but this time we're going to be able to sell two of the 247, 250 call spreads, and we're going to sell one 247, 241 call spread, right? So again, the 247, 241 put spread is $6 wide, right? The 247, 250 call spread is only $2 wide. So if we sell two of those, we're not increasing our max loss here because again, our max loss is based off of the $6 spread here. This time we collect $463. Our break evens are 242.37 and now 249. Excuse me, that should be 239. I'm sorry. 239.42 for doing so, and our max loss here goes down to $137, right? Interesting. So, oh, actually, no, that is 249. I'm sorry. Whoops, 249. Great. So now our max loss on this trade is $137, and that's to the downside. To the upside, it's only about 68 cents. So now this is a trade where our max loss is lower, our profit is higher, and our max return on capital goes up by 3 times, right? It goes up by 3 times to 338%. So if I do it today, I'm going to have to kind of bend the rules a little bit, right? So let's see what happens on a normal dynamic straddle, right? So we're going to sell the at-the-money call and put. We're going to buy the 30 delta call. We're not going to buy the 30 delta put here. We're going to buy the 25 delta put, and you'll see why here in a second. Right? So this strategy, as you guys can see, is $3 wide to the call side, $6 wide to the put side. So we're collecting $291 here. Our break evens are $246.09 and $251.91. Our max profit is $291. Our max loss is $301. Right? But if we're going to make it now a heavy dynamic straddle, what we're going to do is we're going to sell the 249 call, we're going to buy the 252 call, and we're going to go ahead and we're going to do that twice. Then on the other side, we're going to sell the 249 put once and buy the 243 call once. Right? That is an example of a heavy dynamic straddle. The reason for that is because we're able to sell more than one call spread within the put spread to be able to collect more credit and have actually a reduction of risk, right? So pretty cool. So let's look at what that looks like. So again, now our max profit is $434 and our max loss is $166. So big difference there. Really, really big difference there, right? So again, what we're going to try to do in this is we're going to try to buy it back for 25% of max profit, because when we did the actual dynamic straddles, we realized that that was the best strategy for us. And if you don't remember that, go back to the lesson. It should be a couple lessons above. Now, in this 14 and a half plus years, we were able to sell one call spread, just one call spread for one put spread about 30% of the time. About 2/3 of the time, we're able to sell two call spreads for every one put spread. About 1.9% of the time, we're able to sell three call spreads for every one put spread. And 1% of the time, Jesus, I wish that was happening more often, we'd be able to sell four call spreads for every one put spread. So let's see the results. So on the left side of the screen, we see our normal dynamic straddle managed at 25% of max profit, right? So again, great strategy right here. Real profitable strategy, right? 56% of the time for an average of 60 cents per day, and we're in the trade for an average of 40 days. Pretty good. However, when we do our dynamic heavy straddle, when it has multiple call spreads and only multiple call spreads, so two or above, we're right 66% of the time. We're average days in the trade about 34 days, and now instead of just making 60 cents, we make 5 times more per day, or $3 per day. Obviously, if you go back to what we're looking at right here, we're collecting so much more credit. The max loss on the trade where we only have one call spread and one put spread is $309. Our max loss on the trade we have two call spreads for one put spread is $166. So it's completely cut in half. Not only is your max upside doubled, but your max loss is cut in half, right? So that's really, really interesting here, right? Really, really interesting here. So now what we're going to do is take it a step further like we do with everything else, right? It turns out that this heavy dynamic straddle is really, really an excellent strategy. And the reason for that is because our upside is doubled and our max loss is cut in half, right? And we're managing it at 25% of max profit, right? So really interesting. We're making more money on the trade, right? So now we're going to take it a step further. We're going to do the same thing we did last time. And now all we're going to do is we're going to execute these strategies in periods of high volatility, right? So on one hand, we're doing two trades. We're doing a dynamic straddle every single day, and then we're comparing that dynamic straddle every single day to doing it in periods of high volatility. Then we're taking a step further for the last two parts of the study, and what we're going to do is we're going to do this heavy dynamic straddle every single day and only count the periods where we are able to sell more than one call spread in the actual trade. And then we're going to compare that to doing it only in times where, again, you can sell multiple call spreads for every put spread within the dynamic straddle, but now only in periods of high volatility. Again, in periods of high volatility where the expected move is greater than average, options are even more overstated than normal. And volatility is a mean reverting asset, so it reverts to the mean quicker, 3 times quicker, when it is above the average to below, right? So we expect the price of these options to come in pretty quickly. So let's see what that looks like. Again, obviously, selling just a normal dynamic straddle where we're selling the straddle, buying the 30 delta call and the 30 delta put, we almost have double the profitability from doing it every single day to in periods of high volatility. However, and this is really, really big, guys, this is exactly why this is one of my top strategies. This is why there are times when I stay away from a straddle and I go ahead and do this dynamic heavy straddle, is because right here I see 70% winners. We're in the trade for 33 days, and now we make about $4 per day, which is a big 33% increase on just doing it every single day willy-nilly when we do it high volatility. So remember, this trade by itself managed at 25% max profit. We're right at 56% per 40 days, and we make about 60 cents per day. But we've taken that almost, let's see, real math right here, almost 7 times more profitable in just doing it in periods of high volatility, and only when we're able to sell more than one call spread for every put spread. And we're right about 70% of the time for an average of $4 per day, right? So again, a heavy dynamic straddle is what we're talking about here, guys. Super, super powerful, super, super powerful. Selling multiple call spreads for every put spread. And the difference between selling more than one call spread for every put spread is the difference between having double the max profit and half of the max loss. I'll see you guys in the next video.